Something just happened deep inside the US futures market that deserves way more attention than it's getting. The CME group, the single most powerful derivatives exchange on the planet, just pulled out what many insiders are calling a last resort defense. They slammed the market with a sudden and aggressive $25,000 margin increase. This move is designed to cool down a market that's simply refusing to follow the rules. On the surface, this just sounds like a technical adjustment, something for the financial nerds to debate. But in reality, it's a massive signal of stress, a loss of control, and a system that is struggling to contain whatever is building up just beneath the surface. It's a final play, and we need to understand what it means. First, let's be clear. Margin hikes are never neutral. The official narrative always frames them as simple risk management tools. But if you look at financial history, it tells a very different story. Exchanges only raise margins this sharply under specific conditions. 1, when volatility becomes so wild it's completely unpredictable. 2, when positioning in the market grows so dangerously concentrated on one side of the trade that it threatens the entire system. And 3, when the price movement itself threatens the stability of the clearinghouses that guarantee the trades. To put it in simple terms, massive margin hikes happen when someone, somewhere, is losing control of the narrative. And this time it's no different. The exchange is trying to regain control. Now let's talk about why $25,000 is such an extreme number. This wasn't some minor, gradual adjustment. A $25,000 margin requirement per contract does a few things instantly. First, it forces smaller, less capitalized traders completely out of the market. They just can't afford to play anymore. Second, it dramatically increases the risk of forced liquidation for those who try to hang on. The financial pain becomes immense. And third, it heavily favors the big, capital-heavy players, the institutions with deep pockets who can easily absorb these costs. When an exchange pulls a lever this hard, they are effectively screaming, "We need to slow this thing down, and we need to do it right now." But here's the critical point. Slowing down the price is not the same as solving the underlying problem that is causing the price to move in the first place. So what is the CME really responding to? The official explanation, as always, will focus on volatility. But the unofficial reality, the one traders are talking about, points to something else entirely. It points to dangerously crowded positions, where almost everyone is betting on the same outcome. It points to incredibly thin liquidity at key price levels, meaning there aren't enough buyers or sellers to ensure smooth trading. And most importantly, it points to a growing, undeniable imbalance between the paper contracts being traded and the actual physical supply of the underlying asset. Margin hikes don't fix shortages. They don't magically create liquidity out of thin air. All they do is delay the market's inevitable reaction. They are a temporary dam against a rising river. This strategy isn't new. The US market has seen this pattern play out before during other major stress events. Think back to the 2008 financial crisis. Think about the European debt crisis in 2011, or even the market chaos of 2020. In every single one of those cases, margin hikes were used as emergency pressure release valves. And in every single case, they ultimately failed to stop the larger underlying move. They slowed it down, yes. They distorted the price action for a while, but they never prevented the final outcome. This is why this move signals a deep sense of urgency, not strength. Strong, healthy, functioning markets don't need emergency tools like this. When an exchange has to act this aggressively, it's because their own internal models for predicting risk are breaking down. The assumptions they've been using to calculate risk no longer hold true in the real world. The market is officially behaving out of bounds. This isn't a sign of confidence from the exchange. It's a sign of containment. They're trying to put a fire out, not just manage a campfire. And we have to ask who really benefits from this and who gets hurt. These margin bombs, as they're called, don't hit everyone equally. They are precision weapons. They protect the large institutions, the ones with deep capital reserves. But they absolutely punish leveraged retail participants and smaller speculators. They force involuntary exits, making people sell when they don't want to, often at a significant loss. This fundamentally reshapes the market, but not necessarily in a healthy way. It concentrates power into the hands of fewer, larger players. Perhaps the biggest mistake investors can make right now is assuming that a margin hike like this marks the end of the big price move. Historically, it's the exact opposite. These events often mark the middle of the move, not the end. They are a sign that the trend is so powerful that the authorities have to intervene. What typically happens after these emergency margin hikes? First, liquidity, which was already thin, gets even worse. It becomes even harder to buy or sell without moving the price. As a result, price swings become wider and even more violent. And volatility, the very thing they were trying to suppress, becomes even more extreme. The market doesn't calm down. It just becomes less forgiving and more dangerous for anyone who remains. What we're seeing is the illusion of control. Raising margins creates the appearance of stability. It makes the regulators look like they're doing something, but underneath that calm facade, the structural issues remain completely unsolved. The supply and demand mismatches are still there. The underlying confidence in the system continues to erode. Markets don't obey rules forever. Eventually, they respond to the fundamental pressure of supply and demand, and that pressure is still building. So why should an everyday investor in the US pay attention to this? Because this isn't just about one specific asset or one futures contract. This is about system behavior. When the largest and most important exchange in the world has to resort to blunt force tools like a $25,000 margin hike, it tells you something incredibly important about the health of the entire financial system. It tells you that the system is now reacting, not leading. And reactive systems, history shows, are the ones that tend to break suddenly and without warning. This leads to the final critical question. What happens when this tool stops working? Every emergency measure has a limit to its effectiveness. If these massive margin hikes fail to suppress the underlying pressure, what's next? If the market simply absorbs this and keeps pushing, then the volatility escapes containment. The true price, driven by fundamentals, reasserts itself with a vengeance, and control shifts decisively back from the exchange to the market itself. That's when things get truly messy. That's when the price moves become fast, disorderly, and headline-driven. That's when you wake up to news that shocks you. So, let us end with this final thought. The CME Asing S margin move was not a solution. It was a signal. It wasn't designed to end anything. It was designed to buy time. And in financial history, you learn one lesson very quickly. When powerful institutions start desperately trying to buy time, it's usually because they know something much bigger is approaching on the horizon. Markets will always eventually move toward resolution. The forces of supply and demand will have their day. Margin bombs only change how chaotic that final resolution becomes. Keep your eyes open. This is a story that is far from over. When an exchange like the CME Group drops a bombshell, a massive $25,000 margin hike, the knee-jerk reaction is to think, okay, problem solved. Volatility will die down and things will get back to normal. But what if that's not just wrong, but the exact opposite of what really happens? What if that extreme move isn't a sign of control, but a signal that control has already been lost? Let's talk about what history tells us, because we've seen this movie before, and it rarely has a quiet ending. Margin hikes are supposed to be the ultimate circuit breaker. The logic seems sound, right? You raise the cost of playing the game, which forces traders to reduce their leverage, cuts down on wild speculation, and ultimately calms the market down. It's like telling everyone at a wild party that the drinks are now $100 each. You'd expect people to go home. But in a stressed, volatile market, it's not that simple. This isn't a voluntary decision to be more careful. It's a forced action. Traders aren't choosing to reduce their risk. They're being forced to liquidate positions to meet the new, higher margin requirements. And that forced behavior is where the real trouble begins. Instead of a gentle cooling off period, you get sudden, chaotic liquidations. People are dumping assets not because they want to, but because they have to, right now. This creates massive liquidity gaps where there are suddenly no buyers to absorb all the selling pressure. The result? Violent, unpredictable intraday price swings. The very stability the margin hike was meant to create evaporates. The market doesn't get stronger. It becomes incredibly fragile, like a thin sheet of glass just waiting for the next tap. This leads us straight into something called a liquidity trap. When margins jump that aggressively, a huge chunk of market participants simply can't afford to stay in. The smaller players, the independent traders, even some smaller funds, they're priced out. They're forced to the sidelines. With fewer people trading, the market thins out. Bid-ask spreads, the difference between the highest price a buyer will pay and the lowest price a seller will accept, widen dramatically. This means it becomes more expensive just to execute a trade. The order books, which show all the buy and sell orders, become shallow. This creates a terrifyingly dangerous setup. In a thin market, even small orders can move prices in a huge way. Imagine trying to steer a giant cargo ship with a tiny rudder. Every little movement has an exaggerated effect. So, instead of gaining control, the exchange has actually increased the market's sensitivity. It's now primed to overreact to anything and everything. The slightest bit of news, a single large order, it can send prices flying in either direction. The attempt to dampen volatility has paradoxically created a system that is hypersensitive to it. Now, here's the kicker. Markets absolutely despise artificial restraints. They are natural forces, and when you try to artificially suppress them, that pressure has to go somewhere. So, after the initial shock of the margin hike and the forced liquidations, you might see a brief, deceptive period of calm. But what happens when that artificial pressure is released, even for a moment? The volatility doesn't just return, it often comes back with a vengeance, stronger and more aggressive than before. Why does this happen? Think about what the market looks like now. First, the positions are more concentrated. With all the smaller players gone, the remaining capital is in the hands of a few very large players. Second, as we just discussed, liquidity is dangerously low. There are fewer shock absorbers to cushion any sudden moves. And third, confidence is shattered. The extreme measure of a margin hike is a clear signal to everyone that something is deeply wrong with the market is structure. This combination of concentrated positions, low liquidity, and weak confidence is a recipe for explosive moves. When the next big catalyst hits, there's nothing to slow it down. This pattern should feel eerily familiar, especially in US markets. We've seen this cycle play out time and time again. After an extreme intervention from regulators or exchanges, what follows isn't a long period of stability. Instead, the calm periods get shorter and shorter. The subsequent market moves become faster and more accelerated. And eventually, confidence, which was already fragile, doesn't just erode, it collapses suddenly and without warning. The CME's massive margin shock fits this historical pattern perfectly. It's not a solution, it's a symptom of a much deeper problem, and it's a classic setup for the next phase of the crisis. So, who is actually left in the market after an event like this? After the margin hike purges the smaller, less capitalized participants, the only ones who can afford to stay are the heavyweights. We're talking about the massive institutions, the official market makers whose job is to provide liquidity, and the deep capital hedge funds with billions at their disposal. This completely changes the character of the market. It becomes an arena dominated by players who trade in enormous size, who can move in and out of positions with lightning speed, and who will exit without a moment's hesitation if they sense trouble. That is not a stable environment. It's an environment of compression. Imagine a spring being coiled tighter and tighter. On the surface, nothing is moving, but a tremendous amount of potential energy is being stored. That's what the market looks like. It's dominated by a few large, powerful entities all watching each other, ready to react instantly. This isn't the diverse, deep, and resilient market we want. It's a brittle, concentrated one, waiting for a trigger. One of the most dangerous things about this phase is how difficult it is to detect. If you just look at the surface, everything might seem fine. The wild price swings from the initial panic have subsided. The headlines in the financial news have moved on to other topics. The daily trading charts might even start to look flat and boring. Activity drops. But underneath that calm surface, the market's structure is becoming brittle. It's losing its flexibility, its ability to bend and absorb shocks. And brittle markets don't bend, they snap. This is a risk that most investors in the US and elsewhere rarely see coming. There is a common and very dangerous assumption that goes something like this. If the risk were really serious, the regulators or the exchange would have stepped in to fix it. But here's the critical misunderstanding. The margin hike is the step in. That was the big intervention. It was the tool they used to try and restore balance. When that move fails to work, when it actually makes the underlying structure more fragile, the options for what to do next become narrow, and they become narrow very, very quickly. There aren't many tools left in the toolbox after you've already used the biggest hammer. So what happens if the underlying pressure, the structural imbalance that caused the volatility in the first place, continues to build? If the demand that drove prices up is still there, or if the supply shortage is still a problem, then the market will eventually try to find its true price level again. At this point, any further margin hikes become completely ineffective. You can't price people out of a market they are desperate to be in. Instead, liquidity continues to deteriorate, making the situation even more dangerous. And eventually, price reasserts itself, often with incredible violence. The moment the artificial controls fail, control shifts entirely back to the raw, untamed forces of the market itself. This is why this transition zone is the most dangerous phase of all. The early volatility, the initial panic, that's visible. Everyone sees it, everyone talks about it, and everyone is on high alert. But this later stage is far more insidious. It's a period where complacency returns. People think the storm has passed. But in reality, risk is building silently beneath the surface, and because the market is so brittle and illiquid, the eventual repricing happens with terrifying speed. There's no gradual adjustment, it's a sudden jarring snap back to reality. Let's have a final reality check. The CME's $25,000 margin shock wasn't the final chapter of this story. It wasn't the solution. It was confirmation that the market had officially entered a containment phase. And historically, this containment phase is what precedes a final, often chaotic, resolution. Markets are like forces of nature. They will always resolve imbalances one way or another. The only question that remains is whether that resolution will be a smooth, orderly process or a brutal, painful one. The market just got hit with a $25,000 margin shock from the CME, and everyone's breathing a sigh of relief. The headlines say, volatility is contained. The charts look a little calmer. But what if I told you this calm is the most dangerous part? What if this isn't the end of the crisis, but the quiet moment right before the real storm breaks? Today, we're going to pull back the curtain on what's really happening in the US markets and explore the critical question: after a margin shock like this, what breaks first? Let's get one thing straight. The CME's move wasn't a solution. It was an emergency brake. And when you slam on the brakes that hard, something is bound to break. On the surface, things seem stable. Volatility appears to be under control, but underneath, the pressure is building. It's silent, it's relentless, and it's building without any warning signs for the average investor. This is the phase where the market quietly decides who wins, who loses, and how fast the whole thing unwinds. So why is this calm a trap? After a big margin increase, most people assume the worst is over. They see the flatlining charts and reassuring news reports and think, okay, we're safe. But historically, this quiet period is the precursor to some of the most explosive moves we've ever seen. The reason is simple. The very act of raising margins thins out liquidity. It forces smaller players out, concentrating risk into fewer, larger hands. The market isn't safer, it's more sensitive and more brittle than ever before. It's like a tightly wound spring, ready to snap at the slightest touch. So, when that spring does snap, what breaks first? In US futures markets under extreme stress, the first signs of a breakdown almost always appear in three specific areas. First, small to mid-sized retail positions. These are the traders who are forced out by the high margins. They have to sell, and they have to sell quickly, creating sudden gaps in liquidity that can trigger a domino effect. Second, highly leveraged instruments. Think ETFs, options, and other leveraged products. These are designed to amplify moves, and when their underlying assets start to wobble, they don't just move, they react violently. A small dip in a stock can cause a massive drop in a leveraged ETF tracking it. And third, cross-asset correlations go haywire. Stocks, bonds, and commodities, which normally move in predictable ways relative to each other, suddenly start reacting in bizarre and unpredictable ways. Stocks might fall while bonds fall, which shouldn't happen. Gold might not act as a safe haven. When these dominoes start to fall, the cascade can happen literally overnight. Now here's the unfair part. This $25,000 margin requirement doesn't affect everyone equally. It disproportionately favors the deep-pocketed players. We're talking about large hedge funds, institutional market makers, and high-frequency trading firms. These are the players who can easily afford the higher margin. In fact, they thrive in this environment. They control the remaining liquidity, and they can manipulate the order flow to their advantage, picking off the forced sellers and profiting from the chaos. Meanwhile, retail investors are often caught completely off guard. They underestimate just how concentrated and controlled the market has become. They're playing a game where the rules have been changed mid-play to favor the house, and they don't even realize it. The illusion of a fair and open market is over. Exchanges can impose margins. Regulators can issue warnings. But history has proven one thing over and over again. You cannot force a stressed market to behave logically. These measures might delay a move, but they cannot eliminate the underlying systemic pressure. Every single minute that the market is held in this artificial state of calm, the risk is compounding. It's like trying to hold a beach ball underwater. You can do it for a while, but the longer you hold it down, the more forcefully it's going to shoot up when you finally lose your grip. And the trigger for that release could be anything. After a containment attempt like this, the market is incredibly fragile. It doesn't need another massive event to set things off, a minor liquidity event that no one sees coming, a surprising economic report, good or bad, a sudden geopolitical shock from halfway around the world. Any of these small catalysts can produce outsized, cascading effects. The system is so brittle that a feather could knock it over. This brings us to the psychological edge required in these late-stage markets. Most investors are conditioned to wait for confirmation. They think, I'll get out when I see volatility spike, or I'll sell when the news turns bad. But in a late-stage market, waiting is the most dangerous thing you can do. By the time the volatility is obvious, by the time it's on every news channel, the opportunity to exit safely is long gone. The exits are crowded, and the price you get is not the price you wanted. The CME margin hike is not a sign to wait and see. It's a signal flare. It's telling us that we are already deep in the late stage of this pressure buildup. Acting now isn't about panic, it's about awareness. It's about understanding the mechanics of what's happening beneath the surface. Now let's just look at the historical patterns. Think back to the 2008 financial crisis. The initial margin increases in certain sectors only delayed the inevitable collapse of leverage-heavy areas like mortgage-backed securities. It gave a false sense of security. The financial world just got a massive warning shot, and almost everyone missed it. I'm talking about the Chicago Mercantile Exchange, the CME, suddenly jacking up margins to $25,000. This wasn't just some routine adjustment. This was a margin bomb, a last-ditch effort to stop a runaway train. The problem? It didn't work. And now the US market is teetering on the edge of a phase where the old rules simply don't apply anymore. The next moves won't be measured in weeks or months. They'll be decided in hours. This is the kind of stuff you don't hear about on mainstream news because by the time they report on it, it's already too late for you to do anything. So why did this margin bomb fail so spectacularly? Let us get one thing straight. Raising margins can only do one thing. It forces people out of the market by making it too expensive to play. But it can't magically create liquidity where there is none. It can't fix the deep, structural problems brewing under the surface. And it certainly can't calm down a market that's already stressed and dangerously concentrated. By pushing out the smaller players, the CME didn't solve the problem. They just concentrated the risk onto the bigger players who are still in the game. The market hasn't stabilized. It has been compressed. And a compressed market is like a coiled spring just waiting to explode with volatility. Now, what happens when this artificial backstop finally gives way? There are 3 critical weak points that are now dangerously exposed. First, leveraged retail accounts. We already saw forced selling wipe out liquidity at crucial price levels. The retail investors who are left are often highly leveraged, meaning even a small price swing against them could trigger a cascade of automatic sell-offs, making a bad situation much, much worse. Second, we have to talk about derivatives and ETFs, especially the leveraged ones. These instruments are designed to amplify the movements of the assets they track. A small dip in the underlying market can cause an exponential, catastrophic drop in these leveraged products. It's like pouring gasoline on a fire. And third, and perhaps most frightening, is cross-market correlation. In today's financial world, everything is connected. Stocks, bonds, futures, commodities, they're all tied together in a complex web. A sharp, unexpected move in one corner of the market can trigger a chain reaction across the entire system. History has shown us time and time again that this is how confidence breaks. Not just in one specific asset, but system-wide. After a shocks, like a major margin hike, there's often this deceptive period of calm. You look at the charts, and things seem to flatten out. The breathless headlines disappear, and the average investor breathes a sigh of relief, thinking the danger has passed and stability has returned. But this calm is an illusion. It's the most dangerous phase. What you actually have is a market with very little liquidity, where positions are highly concentrated, and all that underlying pressure is still there, simmering. These are the perfect ingredients for sudden, violent spikes in volatility. This is the moment when complacency meets hidden, catastrophic risk. And US investors are particularly vulnerable right now. Why? Because our markets are built on a mountain of leverage. They are deeply interconnected, and the whole system runs on one thing: confidence. Most people's portfolios are built on a few core assumptions: that stocks and bonds will remain relatively stable, that you can always sell when you want to, and that the Fed or some other institution will step in to prevent a true meltdown. But in this late-stage stress environment, these assumptions are starting to crumble. The CME's margin bomb is a blaring signal that relying on regulators or exchanges to save the day is no longer a viable strategy. Think about it. Every emergency tool has its limits. If a massive $25,000 margin hike can't cool things down, what comes next? Price moves get faster and more extreme. Liquidity vanishes in the blink of an eye. Volatility becomes completely unpredictable. The next phase isn't a gradual decline. It's a chaotic, unforgiving freefall. There's a critical psychological lesson here that most retail investors learn the hard way. People say, "I'll get out when things get volatile." But by the time you see that volatility spike on your screen, it's too late. The exits are jammed. Your leverage is working against you at a terrifying speed, and forced liquidations are driving the market, not logic. Margin increases aren't solutions. They are warnings. And those who ignore the warning are the ones who get caught completely off guard. We've seen this movie before. Just look at the 2008 financial crisis. Emergency measures delayed the collapse, but they couldn't prevent it. Once containment failed, markets repriced with brutal speed. Or think about the pandemic crash in 2020. Interventions slowed the initial futures selling, but then sudden liquidity gaps created some of the most violent intraday swings we've ever seen. Even last year, with the regional bank stress, early containment measures made it seem like the problem was solved, only for hidden fragility to erupt later, catching everyone by surprise. The pattern is always the same. Containment tools buy time, but they don't prevent the final, painful resolution. So what is the hidden signal behind the CME's move? That $25,000 margin is not a fix, it's a flare sent up from the heart of the market, signaling that the system is under extreme stress, that the structural risks are still there and unresolved, and that the first moves after this containment fails will be fast, severe, and concentrated. Ignoring this signal isn't just risky, it's practically begging for a forced liquidation and catastrophic, unexpected losses. Let's get to the final warning for US investors. Markets don't care about your convenience. They don't operate on hope or headlines. They operate on raw pressure and imbalance. The CME's margin bomb has already changed the game. Liquidity is now thinner than ever. Positions are more concentrated, and the risk is magnified. The investors who understand these new dynamics have a massive advantage. Those who remain complacent, believing the old rules still apply, risk being completely swept aside. Here's the closing reality check. The margin increase was never about solving the problem. It was about buying time. And in late-stage markets, time is the most precious commodity there is. But when containment fails, a resolution is not just possible, it's inevitable. And history teaches us that this resolution will be faster than anyone expects, more brutal than the headlines will be able to capture, and it will be unevenly distributed, viciously punishing the unprepared. The CME's action has revealed a fundamental truth. The market itself is now in control. Not the policymakers, not the margin rules, and not the talking heads on TV. And in the long history of American finance, the people who recognize these pivotal moments early are the only ones who manage to survive unscathed, or even find opportunity in the chaos. Thanks for watching. If you found this analysis valuable, make sure to subscribe and hit the bell so you don't miss our next update. Stay safe out there.